Hey there people, how are ya? Hope you're doing great as always. And I'm here with another video about kind of the overall market theory, right? Because especially the past, I would say 2 months, the market's been in quite a turmoil, right? And when people get into this kind of situation, when there is so much uncertainty and like anything might happen, and investing, in my opinion, is half brain and half stomach, right? Because you both need to have the proper brain power, knowledge, and understanding to make the right decision, but then also have the stomach for all the volatility and also keeping your coolness when people are basically saying, "Hey, you're wrong. You have to do this or that." You have to have enough knowledge to be confident in your own decision. And lots of people are trying to time the market, right? And in times like this, it's, from my point of view, it's in most of the times a fool's errand, right? There are basically no people that can time the market consistently, right? You can have some good calls, some bad calls, right? But all in all, it's pretty much fool's errand. And in this video, I will go a little bit into some scientific theory, which in a sense supports my case for, not going for timing the market, because yeah, it just never ends well. So we'll take a little bit look about theory, and then what you should do as an investor in order to protect yourself from all of this market turmoil. So let's get into it. And so the first piece of information that kind of goes into our overall puzzle of the stock market is the chaos theory. What does that mean? Let me start with one of the story, right? How basically this concept was discovered. There was one scientist studying weather. I think it was like in the 60s or 70s, and he was basically, weather is a super complicated phenomenon, right? In a sense, similar to stock market, all the price movements, supply and demand, everything, maximum level of complexity. And he was running this weather model, right, on some of those in these days you would say like a simple model, right, because obviously the computers at that point were very basic. But so he basically had that model that was supposed to predict some kind of a data, right? So he was basically starting at a very specific point in time, and he wanted to get to a very specific result. So he ran the simulation for once, get the result XYZ, right? And then he wanted to basically confirm that there was no error along the path, right? So he ran the simulation again. However, the simulation failed somewhere in the middle. So he wanted to restart it, but for that he needed to put the numbers in again. And the number he was supposed to put into was like a number with I think 4 6 decimals, right? Let's say like 1.15678. And when he basically inserted the input again, he did not put all the decimals behind, right? So it was maybe like 1.156 or something. And he continued the simulation. But suddenly the total outcome was completely different. Just this small change in the decimals, you would guess that you might end a little bit wrong, but not far enough. But this tiny change, basically brought you to a completely different point. And the same obviously happens in the stock market, right? It's such a complex system, and basically the complexity is getting much more complex, right, over time. There are, more individual players in the stock market. There are more phenomena around the stock market that are influencing it, right? As there are more people on the planet, as there are more companies involved, as there are multiple countries, you are growing complexity in such a, exponentially. Whereas your kind of a prediction tools, even though they are getting significantly better, they are just playing that, catching up game with the stock market. So that's one of the reasons why it's basically impossible to time the market with level of precision sufficient enough. But there is more. Market is in a sense self-correcting, right? It's now there is this huge discussion, obviously, how it is going to be with the interest rates, with the rate hikes by Jay Powell here, and it's kind of like nobody knows, not even that guy, right? Because he's going to react to whatever market will do at that particular point, right? He doesn't have like a exact roadmap in his head, like, okay, I'm going to do this and that, and it's decided. No, he's going to see what the market is doing, right? So it's not like that there is one clear path, and basically he might be pushed to do a different decision based on different scenarios. We are obviously having this little bit geopolitical crisis on the border of the Ukraine, which is a pretty wild card, right? Because it's in a sense in the hands of a very small group of people who might make certain decisions that will influence the whole market in general. So you cannot predict something that's not decided, right? We are just all the time trying to basically come up with the best solution, right? And the Jay Powell here and his mandate obviously dictates that he's trying to keep the economy in the best shape as possible, hurting the fewest amount of people. And of course, this is a super hard job to do, right? Trying to keep the unemployment low, trying to keep the inflation in a reasonable, in a reasonable size, and that's no joke, right? And he's we'll see what he will do soon, right? In the first quarter, but he might have some strong conviction at this point. What's the roadmap? But going further out, there is so much that still needs to happen for him to make the decision. During summer, some of this, how the CPI data will come later in the year. If the supply chain is still going to be congested, if the tension along the Ukraine border will ease, or if it will keep the same, it might escalate more. And all of these influence, for example, the interest hikes, right? So that's just another reason why it's basically impossible to predict the market in any reasonable manner for most people to make money, right? Unless you just really have the time to stay in touch in like a super short manner. And there are definitely stuff that you can do, and professionals are reasonably successful, but for a common investor is just much simpler to go the other way. So let's take this video into the third act and ask ourselves, what should we do then to basically have as good portfolio as possible that will weather all these storms, right? That can basically swipe through any macroeconomic environment. So the question that remains then is, what should you do as an individual investor in order to have a portfolio that stands the test of time, that will, perform very nicely over the next 3, 5, 7 years, really having that long-term outlook? And for that, I always like to study people that were successful in their own domain, right? And you might have obviously some shorter term concerns, or you might not agree with everything, right? But there are definitely lessons to be learned, and obviously if you are an investor, there is no doubt that you heard about Warren Buffett, right? And the guy obviously has a tremendous track record, right? Especially considering that it's just like uninterrupted outperformance. It's it's decades of experience. And even though you might not agree with all of his picks, even though he made so many mistakes along the road, he was able to amass a massive wealth and make all the shareholders of the Berkshire Hathaway incredibly wealthy. And one of the lessons that basically stuck with me from, basically, for example, reading the Snowball, right, which is basically his the one and only authorized biography that really goes very deep into the whole life of Warren Buffett, and really, making sure that nothing is left aside. And so basically what I would like to leave you with is that Warren Buffett, for his whole life, if you look at it from really a high perspective, he was always a net buyer of stocks, right? Even though he might have been changing positions from time to time, all in all, he was always just accumulating a great assets. And he would most likely agree with the statement that you are basically trying to cut through all this BS that's happening on the macroeconomic scale and really focus on the individual businesses, right? Because if you invest in a business that is well researched from your side and you understand how it operates, and it's a business that's going to do significantly better over time, growing revenue, improving net income, there are basically these these anchors that will make sure that the stock price will basically follow the performance of that business. And even though lots of businesses might be hurt by many different macroeconomic conditions, those businesses that are resilient, one might even say anti-fragile, will just do better over time. And even though they might have some hiccups along the road due to those macroeconomic conditions, you will do just very fine over time. So let me know in the comments, what business have you invested in that you feel comfortable with holding for the next, let's say, 5 years? Do you have a company like this in your portfolio? Let me know. And the usual YouTube stuff, like, subscribe, tell your neighbors, and see you soon.